I'm making another project finance video, and I think this video will have some new things in it. And just to let you know, this video is not about a bunch of mechanical things in Excel. I'm going to walk you through the mechanical issues, and if you want to look at this file, it will be on the website. It's named Structuring and Balloon Payments. Now, before we get into the balloon payments and some of the things that are a little more complicated, I'm just going to walk through some of the structuring issues, and there is some information here that is not on other videos. And the information is really to demonstrate what happens if you run into a debt to capital constraint and you still want to use sculpting. You could do two things. You could shorten the tenor, or you could reduce the increase the DSCR, and I'm going to show you the difference. And I'm also going to show you what the true meaning of the LLCR and the PLCR by taking our sculpting approach and converting it to a cash sweep. I think that's how you demonstrate it. So those are going to be our first issues. In another video, I'm going to make some more difficult data tables and presentations, and finally we'll talk about a balloon payment together with sculpting that I haven't really addressed elsewhere. Okay? Now, I'm going to go past some of these things. This is all what I'll work through with our structuring sensitivities. Okay? And I'm sorry if I'm irritating somebody who's giving me dislikes. I'm kind of sensitive about this. If somebody doesn't like something, I wish you'd just give me a comment. Tell me what's wrong so I can improve myself. Like this horrible like and dislike crap. Sorry about diversion. Okay, now I've got I called it, this is just a sheet named Refinancing. The debt structuring sheet has a lot more complexities related to the balloon payment and to cash flow sweeps related to balloon payment and so forth. In this refinancing, it's actually first and foremost a simple sculpting, and then we sculpt together with a refinancing, and we demonstrate, or I demonstrate, the effect of the refinancing. Now, I changed the generic macros. I told you I'll do a little bit. I'm pressing Control-Alt-C, and then a menu pops up, and you can just color the sheet, and you can just choose your own colors, and I put these true false in as conditional formatting and so on and so forth. So I changed this around. So if I press Shift-Alt-C and I know some people are getting irritated that this is, I'm wasting your time with coloring. So what? Sorry about that. Okay, and so here's that's what you do. You download the new generic macros. I put that on the sheet. Okay, and then we start with some operating assumptions. I put a debt sizing constraint and a DSCR constraint in, and that's the important part. And then we made a tenor of 22 years for a 25-year project. And then I added another variable, and this variable I haven't added really before. We can, if there's a debt to capital constraint, if this thing is causing a constraint and we still want to do sculpting, we can either increase the DSCR, I already said that, or reduce the tenor. So I allowed you to do true and false. Of course, this is just not true. Okay. And then I put some different interest rates and some credit spreads, and I shouldn't have done what I just did. Okay, whatever. Okay. And we have a total interest rate here. And I think, oh no. Oh no. Okay. Oh, that Shift-Control-S worked pretty well. Okay. Not perfectly, but okay. And let me, I want to put a false in here, and let's apply a margin that changes over time, so it's a little. Now I put refinancing, so this is a, and I meant to press Shift Control E, I think. Okay, I hope. And then I put in a refinancing date. And if the refinancing date is far into the future, who cares? It won't apply. And I'll show you why the refinancing is so important in a minute, because if we shorten the debt tenor, we can make refinancing when we have a debt tenor. And then for the debt sizing switch, ignore the refinancing just for a minute. We just say, okay, we have a true and false. It goes to year 22. And as normal, now this time I have a target DSCR. This target DSCR could be, it comes from G108. Let's just look at G108. G108 is it could come from the LLCR method, where we say, okay, let's compute the LLCR from the debt to capital constraint and compute that. Now, if the DSCR isn't applied, we'll shorten the debt tenor. And let me show you. I'm sorry, I'm bouncing around, and I'm very self-conscious these days. Okay, and we do our standard debt sizing. I've said this too much. It's a sum product of the of the target debt service cut off by the loan life divided by an interest rate index. Okay, just some introductory comments, and then we have our NPV. Now, if we could constrain the NPV with a debt size, in this case, there is a debt sizing constraint. Now, if we make the tenor adjustment, we allow the what we do is we simply say, okay, we'll put the regular debt sculpting in here, but as soon as we hit the debt, and as soon as we've paid off the debt earlier because we have a higher debt service, then we're finished. So we constrain the debt. We have a reduced amount of debt. We leave the debt sculpting as if it was a higher amount of debt, but we finish the tenor early, and you just use a minimum statement like I've used so many different times. It's the minimum statement combined with lookup and combined with match index. You don't need anything else, hardly, really. You probably don't need anything else at all. Maybe some if a little. Okay, and then we can add the refinance debt. Now, I'm going to take this little true-false thing I have, and I'm going to kind of show you how this works. Oops, oh no. Uh-oh, somebody's going to complain. Now we put in our refinancing chart. I'm just going to add this little thing. Now, if this just applies only, come on. This applies, maybe I'll put it down here. Put it up here, as if that matters. Okay, right now, the debt to capital constraint, I think, was 85%. So we're financing. We're doing the DSCR is constraining the size of the debt. Now, if I increase the IRR, look, then we constrain the debt with the debt to capital ratio, and I can continue to increase the IRR. I'm reducing the project cost, actually, and then the debt constraint is applying, and when that debt constraint is applying, the total debt, this total debt comes from the debt to capital. I should have put the NPV of the debt in this thing that I was doing on some of the other graphs, okay? And eventually, if we keep pushing it up, eventually, here, finally, when the IRR gets low, actually, then we're hitting the DSCR constraint and the development fee. So if let's go, if we have a debt to capital constraint, we can then increase the development fee and essentially increase our IRR, because you're increasing if the debt to capital is driving the amount of debt, increasing the cost of the project matters. If it's not, it doesn't matter. Okay? Now here's the big question. If we are having a constraint, this one, notice that we have a tighter DSCR, but we're cutting off the debt. So let's make the debt constraint even more extreme. Okay, so we are having a high IRR. And now now in this case, the equity IRR is 16%. It doesn't matter really, although it might matter a little bit. This effect might be different. So the question is, you click on this and you have a shorter debt tenor, and look how dramatic the tenor of the debt. This is the big conclusion. Look at this. I'm going back and forth and back and forth. 16%, 13%, 16%, 13%. Now the question I immediately say here is, oh, okay, we paid the debt off early. What if we refinance? Can we get back to this kind of 16% by just having a tighter debt service coverage and then getting a special big dividend here when we refinance? And my first thing was say, okay, it might even be better. It looks like this is much worse. So we're, again, constraining the debt to capital. This is having a bigger DSCR. This is having a smaller DSCR. We actually have smaller dividends, but we get to refinance. How much does the refinancing help? And that's where it kind of gets interesting. Now, if you do the refinancing, don't be intimidated. The key thing to making the refinancing work is simply to start adding switches. Now, I see these models where they put a whole page of switches. That is disgusting. Disgusting. Put the switches where you need them. Sorry, I'm yelling. So we have a refinancing switch that right now is really far into the future. The first thing to do, so I put a little spinner box around our refinancing, and we can refinance in an earlier year now because we have this debt to capital now. If I put this, I'll use this one over here. This has got the refinancing, so I put it really far into the future. Now, if we change the refinancing switch, okay, there, it's coming. I put a little conditional formatting, and you can look and see how the conditional formatting works with new rule, use a formula, blah, blah, blah. Okay, and if it goes like this, don't worry about that. That's just because of Excel. So right now I'm refinancing in year 10, but we really want to refinance kind of when this early tenor hits. Okay, and then we can see. Now, when we do the refinancing, we first have the switch for the refinancing, and then the first thing you have to do is take your initial debt schedule and just say, okay, let's take the opening balance minus how much we repaid and multiply that by a refinancing switch. And then you go to the refinance debt schedule and you say, okay, starting in the refinancing year going forward, what we can do is do another sculpting exercise. We can use the same DSCR we used before, just as to illustrate. You could, I suppose, change this. But for now, I just want to see what the effect of the refinancing is. And then we start counting our interest rate index. That's the key. You start counting this just at the date of the refinancing. And then you use your same old NPV formula with the sum product where you divide the cash flows by the interest rate index. Divide the cash flows by the interest rate index. No circular reference, nothing fancy. And then you put your interest rate here, okay? And then once you do that, we can have that. So now there's a refinancing. And here's the very interesting thing. The refinancing didn't help very much. Okay? Let's do this with no refinancing. I'm going to push the refinancing out. We get a 13% IRR. It is true the refinancing helps the IRR. Okay? So we just, oops, I went too fast. Okay, so we're just kind of finishing this up with the refinancing, but the interesting part here is it's still better. This is 16% now. It's still better to just have the regular old DSCR. And the other interesting thing is when you are constrained, if you could go to the bank and say, okay, I'm going to get refinancing, and I'm going to get refinancing, and then you're not going to look at my debt to capital constraint, you're going to just look at my real cash flows, then the refinancing really does help. So the refinancing is certainly a big issue, but it's better to have a DSCR sculpting than cut off the DSCR with a debt tenor. I never showed you this before. Okay, enough. Now we'll do one more thing. So I'm going to take the refinancing out. And this is what I've been doing lately. Okay. Now, let's, how about we'll put let's get it so it's a DSCR constraint. Here we go. Okay, so if we have a DSCR constraint, and now again, this doesn't matter because there's a DSCR constraint. I'm going to our basic model and finding how much debt we issued. We issued this much debt, okay, 1051. And here was our interest rate. It changes all around. And then I compute the LLCR and the PLCR. And the LLCR is 1.26. And if I take 1.26 minus 1 divided by 1.26, I say that the cash flow can go down by 20.6%. And I want you to interpret that. And when you interpret that, you go to the credit analysis page, and it takes almost the same cash flows. Now, I'm going to press Shift-Alt-C. Sorry about if you're mad about me making my things, but now you can see where the things come from, and I've done a lot of work to make sure that this whole coloring crap works a little better. Okay, now if we have a cash flow sweep, we take the same debt issue, we take the same interest rates, because I put the interest rates up here, and then instead of no, I got to go up here in the where's the here, this reduction in cash flow, I start with the same cash flow and I reduce it by 20.6%, which means 1 minus this. So this is my new cash flow reduced by that LLCR percent. This is the LLCR percent right here. And then when we put this in, okay, here's what happens. And then I say, let's make a cash sweep. And the cash sweep is so easy to do. We have to have a subtotal. We say, okay, here's the cash after the interest. And we use the minimum function to sweep it away. And when we test the opening balance, and when we've swept the opening balance away, then we stop. And then you can use a wonderful little match and index to match when the debt balance goes to 0, and use the index on the year, okay? The lookup doesn't work here, I think. Yeah, maybe it would, but oh well. Okay, I think it would actually. Here's the point. When I put this in, look, right here, it just exactly pays off in the year 22, exactly when it was supposed to. And that shows you that the LLCR really, if you have a full cash flow sweep, an enormous if you don't leak anything out in dividends, it shows you that you can pay off, you can take all the cash flow, sweep all the cash flow, and pay it off in exactly the maturity year. Let's do another one. Let's say I put, instead of by the way, then I recompute the LLCR. We use the sum product. We need to use the same sort of thing where we put a sum product function and divide it out. And this is not a forward LLCR, sorry. And this gives you exactly an LLCR of 1 when we reduce it, exactly what it was supposed to be. But we still, from the PLCR, we still have 8% more reduction because we have a little bit of a tail. That's what the PLCR does. Now, if we do the same thing, so I'm going to the credit analysis, And this is supposed to really illustrate the kind of difference between credit and structuring analysis. If we go and put instead the 27% in, I should have formatted that differently. Then what happens when we go down to this cash sweep, again, it pays off, look, exactly. No rounding, no nothing. It pays off exactly when it's supposed to pay off at the very last year. And it shows you how much the cash flow can go down and I still make all our loan payments. That's what the PLCR does. It shows you can go down by 27%. Of course, if you change all the parameters of the structuring around, you get different answers. And I am stopping the video here. This is called debt structuring and balloon payments. And it doesn't have a lot of tax stuff, but it's, I think, got some important issues.